Hey crypto fam, welcome back to Cutting Edge Crypto, where we break down the latest in the world of digital assets. I'm Damien, and today we're diving into some of the biggest updates in the crypto space that could seriously impact you. From new legislation in the UK that could change how crypto is treated under the law, to massive Bitcoin buys that signal institutional confidence, we've got a packed episode today. We'll also be covering the SEC's ongoing confusion about whether certain tokens are securities, a potential privacy leak concerning Monero, and what the future might hold for stablecoins like Tether. So, get comfortable, grab a coffee, and let's dive right in. First up, let's talk about some major regulatory news coming out of the United Kingdom. On September 11, 2024, the UK introduced a bill that could finally bring some much-needed clarity to the legal status of cryptocurrencies in the country. For years, one of the biggest obstacles for businesses and investors in the crypto space has been the lack of regulatory clarity. This uncertainty has made it difficult for companies to know what rules apply to them and for investors to feel secure about the assets they're holding. Now, this bill seeks to change all that. The key takeaway here is that the bill introduces a new category called Digital Settlement Assets, or DSAs. What are DSAs? Essentially, they are digital assets, like cryptocurrencies and stablecoins, that can be used for settling transactions. The bill makes it clear that these DSAs will be legally recognized in the UK, meaning they have the same legal protections as other forms of property. One of the most important aspects of this new legal recognition is that it brings DSAs under existing fraud protection laws. In other words, if you're scammed or defrauded while dealing with crypto, you'll have legal recourse to recover your losses. That's a big deal for the crypto community, especially considering how often we hear about hacks and frauds. But it's not just about fraud protection. This bill could also pave the way for more traditional financial institutions to get involved in the crypto space. Banks, hedge funds, and even pension funds have been hesitant to invest in or deal with crypto because of the regulatory uncertainty. With this bill, the UK is making a strong statement. Digital assets are here to stay, and they will be treated seriously under the law. So, what does this mean for you as a crypto investor or enthusiast? First off, if you're based in the UK or trading on UK-based platforms, this should give you more confidence in the legitimacy of your transactions. No more operating in a gray area where you're not sure if the law will protect you. And even if you're not in the UK, this bill could set a precedent for other countries that are grappling with how to regulate crypto. If the UK's approach proves successful, we could see similar laws being adopted elsewhere. But of course, we're still in the early stages. The bill has been introduced, but it has yet to pass through Parliament and be enacted into law. There's still a lot of debate that needs to happen, and we'll have to wait and see how the final version of the law looks. Either way, this is a significant step toward greater regulatory clarity in the crypto space. Now let's shift our focus to the United States, where the regulatory environment is, well, a bit more confusing. The Securities and Exchange Commission, SEC, has been a major player in the crypto space, especially when it comes to determining whether certain cryptocurrencies should be classified as securities. This has been a hot topic for years, and recently, the SEC admitted that they may have caused some confusion by suggesting that certain tokens are securities. Let's break this down. The SEC has been going after various crypto projects, saying that many of them are selling unregistered securities. For those who might not know, a security is basically any financial asset that can be traded and represents some sort of ownership, like stocks or bonds. The problem is that under current laws, securities are subject to strict regulations that protect investors from fraud and ensure transparency. In the SEC's view, some cryptocurrencies, particularly those that were sold in ICOs, or initial coin offerings, meet the legal definition of a security. And that's where things get complicated. A lot of these projects didn't register their tokens as securities because they didn't think they needed to. But now the SEC is saying, actually, those tokens you sold, yeah, they're securities, and you didn't follow the rules. The crypto community, of course, has been up in arms about this. Many argue that applying securities laws to tokens doesn't make sense because crypto operates in a decentralized global environment, unlike traditional financial assets. And now the SEC is backpedaling a bit, saying that they regret the confusion they may have caused with their statements. So, what does this mean for you? If the SEC decides to classify the token you're holding as a security, it could have serious implications. For one, the project behind the token might face legal action, which could cause the value of the token to drop significantly. In the worst-case scenario, the project could be forced to shut down or delist its token from exchanges. On the flip side, if the SEC provides clearer guidance on what constitutes a security, it could bring more stability to the market. Investors would know which projects are compliant with the law, and legitimate projects would be able to operate without fear of sudden regulatory crackdowns. But until we get that clarity, the regulatory uncertainty is going to keep a lot of people on edge. At the end of the day, what we really need is a well-defined regulatory framework that strikes a balance between protecting investors and fostering innovation. The crypto space is still relatively new, and the rules that apply to traditional financial assets don't always make sense here. Let's hope the SEC figures that out sooner rather than later. Now let's talk about something that's sending shockwaves through the privacy coin community: Monero. For years, Monero has been considered the gold standard when it comes to privacy and anonymity in cryptocurrency transactions. Unlike Bitcoin, where every transaction is recorded on a public blockchain, Monero uses advanced cryptographic techniques to mask the details of its transactions. This has made it the go-to coin for people who want complete anonymity, whether for personal privacy reasons or for operating in black markets. But recent reports suggest that Monero might not be as untraceable as we thought. A leak involving the blockchain analysis firm Chainalysis seems to indicate that there are vulnerabilities in Monero's privacy features. Law enforcement agencies and companies like Chainalysis may have found ways to trace some Monero transactions, which is a major concern for anyone relying on the coin's privacy features. The details are still a bit murky, but what we do know is that this could have serious implications for Monero and other privacy coins. If law enforcement can trace Monero transactions, it would undermine the core reason people use the coin in the first place. This leak also raises questions about how much longer privacy coins will remain under the radar of regulators. Governments around the world are increasingly cracking down on crypto, and privacy coins like Monero are likely to face even more scrutiny. Some regulators argue that privacy coins enable illegal activities like money laundering and tax evasion. If Monero's privacy features are compromised, that could be the beginning of the end for privacy coins as we know them. So if you hold Monero or any other privacy coin, this is definitely something to watch. Will Monero's developers be able to patch these vulnerabilities? Or is this the first sign that the era of privacy coins is coming to an end? We'll have to wait and see how this plays out, but one thing is clear: the crypto landscape is changing, and privacy coins are going to have a tougher time flying under the radar. Next on the agenda, let's talk about a massive Bitcoin acquisition that has everyone in the crypto world buzzing. MicroStrategy, the business intelligence company led by Michael Saylor, has once again made headlines by purchasing a whopping 18,300 BTC for $1 billion. This brings their total Bitcoin holdings to over 152,000 BTC, making them one of the largest institutional holders of Bitcoin in the world. For those of you who might not know, MicroStrategy has been a Bitcoin bull for quite some time. Michael Saylor famously shifted the company's treasury strategy to focus on Bitcoin, citing its potential as a long-term store of value. And despite the volatility in the market, Saylor and his team have continued to buy Bitcoin, even when prices dip. This latest purchase is significant for a few reasons. First, it signals that despite all the regulatory uncertainty and market volatility, MicroStrategy remains extremely bullish on Bitcoin's future. They're not just holding on to their existing Bitcoin stash, they're actively adding to it. This suggests that they believe Bitcoin's price will rise significantly in the future, especially with the next halving event coming up in 2024. Second, this move could inspire other institutional investors to follow suit. When a publicly traded company like MicroStrategy makes such a massive investment in Bitcoin, it sends a strong message to the broader financial world that Bitcoin is not just a speculative asset, it's something worth holding for the long term. Other companies, especially those with large cash reserves, might start thinking, if MicroStrategy is betting this much on Bitcoin, maybe we should too. And let's not forget the potential macroeconomic factors at play here. With global inflation concerns and increasing skepticism around fiat currencies, many investors see Bitcoin as a hedge against traditional financial instability. If inflation continues to rise or fiat currencies lose value, Bitcoin could become an even more attractive asset for institutions looking to preserve wealth. Now, what does this mean for you, the retail investor? Well, if you're holding Bitcoin, news like this should give you some reassurance. When major players like MicroStrategy are confident enough to pour billions into Bitcoin, it's a good sign that they believe the price will go up. Of course, no investment is without risk, but seeing this level of institutional confidence can make you feel a bit more secure about your own holdings. So, keep an eye on MicroStrategy and other big players as they continue to accumulate Bitcoin. Their actions could signal where the market is headed. Speaking of Bitcoin, and maybe the reason why Michael Saylor buys so much, let's dive into the next topic. Could Bitcoin soon hit six figures? A lot of investors and analysts are saying yes, and they're pointing to several key factors that could drive the price over $100,000 in the near future. So let's break it down. First, we've had the Bitcoin halving, which took place back in April. For those of you who don't know, a Bitcoin halving is when the reward for mining a block is cut in half, reducing the number of new Bitcoins being created. Historically, halving events have been followed by significant price increases because they reduce the supply of new Bitcoins entering the market, while demand often stays the same or increases. Second, there's growing institutional interest in Bitcoin. Companies like MicroStrategy, Tesla, and even some hedge funds are buying Bitcoin and holding it as a long-term asset. When institutional money flows into Bitcoin, it tends to have a stabilizing effect on the market and can drive the price up as more large-scale investors enter the space. Third, there's global macroeconomic uncertainty. With rising inflation and concerns about the stability of traditional fiat currencies, many people are turning to Bitcoin as a hedge against economic instability. This has been especially true in countries with high inflation or unstable governments. Bitcoin's decentralized nature and limited supply make it an attractive option for those looking to protect their wealth from devaluation. Now, not everyone agrees on the timing. Some experts are saying that Bitcoin could hit $100,000 as early as 2025, while others think it might take longer. But one thing is for sure. Many investors are confident that Bitcoin's price is going to rise significantly in the coming years. What's important for you to consider is how this fits into your own investment strategy. If you believe in Bitcoin's long-term potential, this could be a good time to accumulate more. But remember, crypto markets are highly volatile, and there are always risks involved. Always do your own research and make sure your investment decisions align with your financial goals. Let's pivot back to the UK for a moment, because there's another major legal development that's worth discussing. In a landmark ruling, the High Court of England has officially recognized Tether, USDT, as property. This might sound like a small technical detail, but it has huge implications for the legal status of stablecoins in the UK and potentially around the world. So, why is this ruling important? First, by classifying Tether as property, the court is essentially giving it the same legal protections as other forms of property, like real estate or stocks. This means that if someone steals your USDT or you're involved in a legal dispute over it, the law now recognizes your ownership rights and you can take legal action to recover it. In the past, the legal status of stablecoins like Tether was murky at best, making it difficult for users to seek legal remedies in the case of fraud or theft. Second, this ruling could set a precedent for how other stablecoins are treated under the law. Stablecoins have been a controversial topic in the crypto world because of concerns about their reserves and whether they're fully backed by traditional assets. However, this ruling gives stablecoins like Tether more legitimacy, which could encourage their adoption in traditional financial markets. It could also lead to more clarity around how these assets are regulated and used in everyday transactions. For Tether users, this is a win because it adds a layer of legal protection that wasn't there before. It also shows that stablecoins are increasingly being integrated into the broader financial system. We're likely to see more rulings like this in other jurisdictions, which could further solidify the role of stablecoins in global finance. And speaking of Tether, let's discuss their latest move to enhance relations with governments and regulators. In light of the UK's decision to recognize Tether as property, the company is now actively working to improve its standing with regulatory bodies. This is a smart move because, as we've seen, stablecoins are under increased scrutiny from regulators around the world. For a long time, Tether has faced questions about whether it is fully backed by reserves, and this has led to concerns about its stability and reliability. By working more closely with regulators, Tether is trying to position itself as a compliant, transparent, and trustworthy stablecoin. This could help it avoid some of the regulatory pitfalls that have plagued other crypto projects and stablecoins in the past. But why is this important for you? If you're using Tether or other stablecoins, you want to know that the company behind it is playing by the rules and that your assets are safe. Tether's efforts to strengthen its government relations suggest that it's taking regulatory concerns seriously, which could increase trust in the stablecoin and make it a more stable asset for users. In the long run, Tether's proactive approach to regulation could lead to greater adoption in traditional finance. We're already seeing stablecoins being used in everything from remittances to decentralized finance, DeFi applications. As Tether works to solidify its position in the market, it could pave the way for more widespread use of stablecoins in everyday transactions, making them an essential part of the financial landscape. All right, folks, that wraps up today's episode of Cutting Edge Crypto. We covered a lot of ground today. What's clear from all of this is that the crypto world is evolving fast. Regulations are becoming clearer. Institutions are getting more involved, and the market is maturing. Whether you're a seasoned investor or just getting started, it's crucial to stay informed so you can navigate these changes with confidence. Thanks for tuning in. Don't forget to like, subscribe, and hit that notification bell so you never miss an update. If you've got any questions or thoughts, drop them in the comments, and I'll get back to you. Until next time, stay sharp, stay safe, and stay curious.